Digital Realty Trust stock, ticker symbol DLR. This stock is up 33% year to date, beating the overall market big time. On the 26th of October, DLR presented quarterly results where they reported a beat on revenue but just missed barely on FFO expectations. People love DLR stock because of multiple reasons, one of them being the dividends, and I understand why with dividend yield at 3.6% and 18 years of dividend increases. So could this be the perfect moment to buy DLR stock? Well, I'm very excited to see what you guys think about this stock, so please let me know your thoughts in the comments. My name is Thomas and this is Thomas Invest. I'm an investor looking for great stocks at great prices. So what does DLR do? Digital Realty Trust is a real estate investment trust, which is engaged in the business of owning, acquiring, developing and operating data centers. If we dive in the most recent earnings report, we see that DLR reported net income of $2.33 per share, compared to $0.75 last year. FFO was reported at $1.55 per share, flat year over year. This is something that I don't like. It's one of the most important numbers with REITs, and it isn't growing year over year. Same capital NOI growth was reported at 9.4%, which is a great number. Revenue was reported at $1.4 billion, up 18% year over year, and up 3% quarter over quarter. To me, this looks really good. DLR has more than 5,000 customers and 300 data centers. It is the 5th largest publicly traded REIT in the US. The ratings look decent at B, but I prefer A ratings to be honest. And if we look at the geolocation breakdown, we see that North America represents 54%, while EMEA is sitting at 31%. To me, this looks pretty good. A really important number to me is the net debt to EBITDA. Right now it is sitting at 6.2, which is a great number. I prefer a range of 5.5 to 6.5 here. DLR really loves to increase the dividend, and they have a great historical track record of doing so. And if we check the customer type breakdown, we see that cloud represents 36% of the revenue, while network, the second biggest segment, represents 17%. The top 20 customers represent almost 50% of the revenue, and we see some big names in this list. The biggest tenant represents 10% of the ABR, with 68 locations. Overall, the diversification looks really good to me. For the full year of 2023, DLR expects to report a revenue of $5.4 billion to $5.5 billion. Which is a little bit lower versus previous guidance numbers. EBITDA looks really good and the occupancy rate is also expected to be a bit lower. The same cash NOI growth on the other hand is expected to be a bit higher. EPS is also looking pretty good to me. And now that we know more about the company, it's time to check the fundamentals of this stock. But first, if you made it this far into the video, I want to thank you a lot for watching this video. Make sure to subscribe to my channel to receive multiple analysis every week, and also join my Discord channel for free to meet other people within the community and to talk about stocks. It's completely free, so don't miss it out. Let's continue with diving into the fundamentals. DLR is a 41 billion market cap company. PE ratio is not a fair metric to use with REITs, so I'll be using the price to FFO instead. Right now it is sitting at 23, indicating they might be overvalued. Later in this video I will show you my 3 price targets for DLR stock, so make sure to watch until the end, because price to FFO is only telling a small part of the full story here. Revenue is at 5.34 billion and in this graph we see that revenue went up in the long run. I really like the steady growth here. We see that margins are going up and down quite a lot. The good part is that most recently the margins are increasing again. EPS is following the same pattern, so this is something to keep your eye on. Analysts expect EPS to increase in high numbers in the coming years, with growth of 25 up to 70%. For the revenue, it is really looking interesting with a big increase in 2023. But after this year, it is expected to see mid-single to low double-digit growth, which is still great, don't get me wrong. Return on assets is sitting at 3.9%, which is a low number for a REIT. Return on equity looks okayish, and the most important number, return on invested capital, is sitting at 1%, which is a low number, also because it's lower versus the 5-year average. Current ratio is at 1.11, which is a decent number. The thing I really like here is the fact that it has been steady for a really long period of time. Right now DLR has 18 billion in debt, and I prefer companies that can pay down at least a big chunk of their total debt with the total cash. DLR has 1 billion in total cash, so they can't pay down a big chunk of their total debt. This is a potential red flag to me. So it's very important that free cash flow is growing, since this is used to pay down debt of course, but also to buy back shares, pay dividends and all other things. And here we see that free cash flow is going up in the long run, which is a great thing. But it is not always steady and consistent. Shares outstanding are increasing, which is very common for a REIT since they increase shares to raise capital. When shares outstanding are decreasing, it increases your ownership in the company, increases the EPS, lowers the PE ratio and makes it easier to maintain and increase the dividends. And since we're talking about dividends anyways, dividend yield is sitting at 3.58%, which is a great number. Annual payout is $4.88 and payout ratio is at 74%, which is around the average for REITs. The 5-year growth rate is at 4%, which is a decent number. They have increased the dividends for 18 years in a row, which is pretty impressive. And here we see the dividends paid since 2012. They have been increasing the dividends at a consistent rate. In 2020 and 2021 the increases were lower, and in 2022 they started to increase again at slightly higher numbers. In this graph we see the expected dividends in 2023, 2024 and 2025. Of course this is an estimation and can be highly impacted by results, but it gives you a rough indication. It's expected to increase at historical pace, which is fine by me. Overall the dividends look really good to me, but how about the historical returns? I decided to compare DLR stock with the overall market, in this case the S&P 500. Next to that I added EQIX and CCI. On the 5-year chart we see that DLR was beaten by the S&P 500 and EQIX. In total DLR returned 47%, and this is including dividends. EQIX had the highest return with 127%. On the 1-year chart it looks pretty different, with DLR beating all stocks in this list, including the S&P 500. In total DLR returned 28%. On the 6-month chart it is again DLR that is having the highest return, 61% in total, beating the others in this list big time. On the 1-month chart it is again DLR that is beating the S&P 500 with a big difference. CCI has the highest return with 17.8%. So bottom line, DLR was beaten by the S&P 500 in the long run, but most recently it is getting some momentum. So could this be the perfect time to buy DLR stock? Well, let's check the 3 price targets that I created using the Everything Money software, which is one of the best deals out there. I'm using a low, mid and high assumption to get the 3 price targets, starting off with revenue growth. For the revenue growth I'm filling in 6, 8 and 10%, based on the historical performance, their own outlook, but also because of the analysis. For the profit margin I'm filling in 17, 17.5 and 18%. And for the free cash flow margin I'm putting in 30, 32 and 34%. For the PE ratio I'm putting in 20, and for the price to free cash flow I'm putting in 18, 20 and 22. My desired annual return is 12.5%, since I can get an easy 10% average annual return with owning an ETF. Right now DLR stock is at $136. I hit analyze and we see a lot of red numbers. And since this is a REIT, I'm only focusing on the discounted cash flow value. We have a low price target of $85, which is a big drop from the current stock price. We have a mid price target of $113 and we have a high price target of $149. To me, the mid to high price target is the most justified here, indicating that this stock looks overvalued right now. My final conclusion on this stock is that I do love the business. They are capable of growing at high numbers and to me they are also future proof. Most fundamentals look really good to me except from the current debt situation. Dividends also look really interesting with a strong historical track record and also a high dividend yield. The valuation looks a little bit off to me right now. It feels like you pay a strong premium for the stock and I prefer lower numbers here to be honest. So for now I will be waiting for the stock to come down in stock price before opening a new position. But it is definitely a stock that deserves some attention. And remember to always do your own research and never fully trust on what I or other YouTubers say about a stock. I'm not a financial advisor and this content is just for entertaining purposes only. I hope you liked this video and I did bring some insights of the company to you. I'd really appreciate a thumbs up and make sure to subscribe to get notified when I'm posting a new video. Thanks for watching and I will see you in my next video.